Welcome to the Acid Capitalist podcast. Yes, your ears do not deceive you and neither do your eyes. I have returned. If anyone has just joined us over the last few weeks and wonders, who the hell is this guy? No, I'm not Hugh Hendry. My name is Chris Sweeney, also known as The Alchemist. And Hugh has been on a world tour and basically left me behind, just sort of minding my own business in London town, bored, alone, no friends. I'm calling him, he doesn't answer. He's just been regaling us with tales with hanging out with supermodels. I kid you not. Anyway, I will bring him in. Mr. Hugh Hendry, the Acid Capitalist. How are you today?
Chris, heavens, blowing a gale here. I'm protecting you. I mean, the places, the dens of iniquity that I have to go, the things that happen between midnight and 4 in the morning, I'm protecting you. Clearly, I mean, I am the barrier to your sanity.
Well, he also mentioned rock stars, people, and an extremely well-known supermodel. But what we'll do is we'll wait maybe till another episode, and I will extract his personal stuff for this world tour because there's a lot of juice there. I see the questions you ask him; it's all economic stuff, but we want to know what happened backstage at Bloomberg and who he was hanging out with and what he did and all that stuff. But we will get to that. But more importantly, today we have a wonderful guest with us. His name is Jeffrey Sherman, the Deputy CIO at DoubleLine Capital. And this is a mashup podcast. He's going to be putting this out on his platform, the Sherman Show. So, Jeffrey, welcome to the show, and thank you for sharing your platform with us.
Absolutely. I'm looking forward to the remix. We'll see what we can do with it. Exactly.
And you're out in Santa Barbara. So tell us a lot about yourself, your job at the moment, what you do. So, give us a broad stroke so anyone doesn't know you.
Yeah, no, I'm the Deputy Chief Investment Officer at DoubleLine. We oversee roughly about $100 billion of assets under management across a multitude of strategies, whether those are fixed income oriented. We run some systematic equity strategies. We run a systematic commodity strategy. So really a lot of kind of the global macro things that, Hugh and the team is familiar with on his side. We kind of package those up in products, whether they're institutional based, retail focused, whether it's mutual funds, ETFs, and the like. So we consider ourselves a full service investment manager. And, we build products that we want to invest in. And we think that, our clients want to see from us and the vehicles they want to see.
And did you say 100 billion? Is that 100 yards here? That's a nice correct. Number, huh?
It's like a football field, 100 yards. Yeah, exactly. So.
Oh, that's nice. That's nice. So, what did you guys? How long before you got up to 100? Have you been there for quite a while? Was it a steep rise, or was that a slow journey up the mountain?
Yeah, well, we founded the firm about 12 years ago, and so it was founded by Jeffrey Gundlach, and 45 of us got together with him to really start DoubleLine as we know it today. And so the rise was obviously pretty slow at first, and then you kind of have your hockey stick moment, right, as people talk about, right, the convexity moment, as the bond nerds would say. But we got to about 100 billion back in 2016. We've been above that, obviously, with the carnage in the markets this year. It's taken a little bit of a hit to the AUM as well. But we've been at or around 100 billion right now for about six years or so. And so again, it's one of those where it's a year where all asset classes are under duress, right? Except probably the commodity space, and in some cases the vol space. But ultimately, what it is just trying to keep your eyes on the prize, right? It's trying to manage through this. It's important to be a risk manager today. There's as much uncertainty as we've seen in markets, but the good news is that a lot of these markets are some of the most attractive they've been in over the last decade or so. So it's starting to get to where it's a really solid opportunity set. The problem is that clients just don't want to look at their statements, right? It leads with a negative sign, regardless of where you're invested today. And at some point there'll be stability. But the nice thing about the fixed income world is that at least when you look at the landscape, you can start with yield. You can kind of ding the stuff up. You can underwrite the credit. And you can get to the point where you can say, look, there is a very significant opportunity there.
Brilliant. Well, Hugh, come on, 100 yards, pretty sexy. And what do you make of the DoubleLine system? Are you a fan? Do you dig it?
I'm just wondering, do you have to be called Jeffrey to get an operational role in the business?
Yeah, there's 5 of us. So out of the 200 and roughly 290 employees we have, there's 5 of us with that moniker. But as I like to tell people, there's only one Jeffrey. That's Mr. Gundlach. So I am colloquially referred to as Sherman. around the office, and and the other folks that have a Jeffrey name also go by their last names as well. But you don't call Gunlock Gunlock. He goes by Jeffrey.
And I found initially I was persuaded to change, but like a cuckoo, is it a cuckoo? No, it's not a cuckoo. It's a blackbird, I believe.
No, it's a magpie.
Magpie. Thank you, Chris. A magpie furnishes. They say that a magpie can observe its image in a mirror, and therefore when it's nesting, it steals shiny baubles for the nest. And so when I was operating my macro fund, I pursued that magpie approach, and I had lots of crazy people in my 5 people were a little bit deviant, like deviant in the right sense. Is that the case with? I mean, deviant's not the word I wish to use. Colorful.
Yeah, I think there's a lot of quirky individuals, right? I mean, when you work on a trading desk, you're just going to have a lot of different personalities, and so I think one thing that when you look at our team, we have a lot of stability. And so if, I said that we all started to join DoubleLine 12 years ago, but if you look at the average tenure of our portfolio management staff, on average, we've been working together for about 16 years now. What you get is that you have these quirky behaviors, you have these idiosyncrasies across personality types, but somehow it works, right? It's like you need that to have idea generation too. And so I think that's one thing we've tried to foster a culture that allows people to, be themselves, right? Be the asset capitalist if you want, right? But also foster that area that allows people to really, challenge each other's thinking, right? And so what I always found interesting about the investment world is that no two environments are the same. There's a lot of rhyming out there, but you've got to poke holes in the investment thesis all the time. And I think that's very important. And so I think some of that comes down to having different personalities as well, right? You need different views, different cultures, and that really does shine through the investment lens.
Yeah, I mean, indeed, that's why we reached out to you guys, because this is a universe of gray, boring people disseminating a code which is off-putting to the majority. Whereas I always think of you as providing color, and like you say, to have the merest glimpse of what might happen, you have to be marching to a slightly different beat. I mean, that's the ethos behind asset capitalism. But where you excel, because I mean, you guys, I think you had one of the fastest, most rapid accumulation of assets in the history of mankind. And that, for me, that was wonderful, because normally there's this terrible barrier of conservatism where they think, I like you, you're titillating me, but I'm not sure about giving money, not to the crazy guys. So it's always a balance between, hey, we're a little bit unhinged, but boy, do we see the future, and boy, do we deliver. How do you manage that kind of, it's a high wire act sometimes?
Yeah, I think it's, that's what the guardrails come in, right? It's that, even though you have these ideas, it doesn't always permeate the structure of the fund or the strategy at the time, right? Because, you can't be too far out there, but you got to be out there enough to be differentiated. So it is a balancing act. And I think a lot of that comes down to just really, having engaging conversations among the team. And what that is just, bringing new research to the table, trying to poke holes in the way the portfolio looks today, looking at new asset classes, new types, new instruments out there. And so I think you've got to be sexy enough, right, to get people to have interest, but you can't be so sexy that no one wants to come to the party with you, right?
Yeah, and then there is that, once you reach the incredible scale which you guys have attained, it's kind of like you've got to beat back the forces of inertia. It's like, hey, let's just let's stay where we are. It's kind of nice. And someone's going to keep challenging and say, come on, no, if we just consolidate, we lose the creativity. Without creativity, who are we?
That's right. And I think that's the thing too, as we've, kind of launched into, let's call it the hybrid world and everything. I think it's actually fostered more creativity personally. And that's because you have more time to think by yourself. You're not pulled into the bureaucracy of meetings all the time, as well, or just the random things that go on a trading desk every day. And so, I think it is, the lifeblood of investment management is ingenuity. Yes, there's a lot of duplicity, right? It's not that we're creating everything from scratch, right? There's a lot of me too, and you get someone else's good idea and you try to make it better. And so I think just having kind of that sketch pad or the sandbox to be able to play in, I think it's very important. And I think that's what we try to do with our younger staff too, is try to encourage them, to really just learn everything you can, right? Ask questions, get around smart people, and see what you can pull out of there too. And so there's a lot of good ideas that come from the younger staff as well. And I think that's something that we're very proud of.
Can I ask, Jeffrey, you talked about your sandbox here. So, what's your creativity? How do you do it? Obviously, you're an experienced guy, where do you get your ideas from now? And, what sort of flicks your switch in terms of coming up with stuff?
Yeah. Well, you just have to be well read at the end of the day, right? I mean, you have to be a student of history. I think that's very important, right? You've got to learn you never get the feel for a market unless you've lived through it, right? We can all talk about the crash of '87, but if you weren't there, I was not there. You have no idea how that feels, right? And so we've seen some crises now, at least in my career. I've been doing this for about 2 decades now, and you learn a lot from those environments too. But really what I think it comes down to is understanding the theory. You've got to stay on top of, kind of journal articles and just, what are the cutting edge things, understanding that a lot of it is just repackaging, rebranding. There's not a lot of new ideas out there, as I said, especially on the quant side. A lot of it's been out there. It's just the quants never told anybody about it. They write it down now, right? And by writing it down, they've made it a lot cheaper for people, right? But I do think that you have to stay apprised of the research, and you've got to follow the macro data. To me, I always feel like macro guides markets. It's not going to tell you when to time to get in or out, but it does help you. It does give you that kind of shining light, right? It's your North Star to help really start the thought process. And so from there, it's creating a framework. And then, I love sounding ideas, but with my team, right? I mean, at the end of the day, that's what we're trying to do is what's wrong with this? How can we improve this process or improve something to the portfolio? And so I think it's a lot of it is just, being engaged and curious about it. And you have to kind of stay on top of everything.
Yeah.
There's no roadmap there, but.
And you spoke about the kids, and the kids are, I think, vitally important. The selection, vitally important. That you're only as strong as you have a team that are willing to push back at you. That's hard for junior members, but they're not serving you any utility unless they're fearless and they say to you, Jeffrey, you're wrong. That's
no, you're right. And I think the other thing is that they're going to make mistakes, right? And I think they're really nervous to make those mistakes. We've all put together a report or something, and it's absolutely incorrect, and you think it's the most marvelous piece of work you've ever done. And I think that the thing about this business is that it's very humbling, because you have the upper echelon of the IQ spectrum, right? People get in this business to make money, and so there's a lot of smart people. There's a lot of competition. But anyone can thrive in it, right? You don't have to be a scientist. We have poli-sci majors. I guess that technically that is a sci, right? That's a scientist. But you have all walks of life in there. I mean, I have a couple physicists around me. I mean, I think it brings more of the appeal of just having these different backgrounds too. So I think challenging people is right. I think making it a highly competitive environment is very good, and I think it's healthy.
Yeah, no, I agree. You should encourage them to read Jane Austen.
Yeah.
To read, like you say, reading is very important. But I think so. I find this conversation. Thank you for participating and joining with us, because I've given it great consideration, that whole notion of creativity. And like you say, this is before we had these global tech platforms that that just go to one in world domination, and where, you know, you could be Mark Zuckerberg, or you could be, you know, Elon, and the richest man on the earth. Before those guys, the highest return on intellectual capital is what we do. And right. I think you played to that. Therefore, it's rational to expect the participants in this activity are amongst the smartest people on the planet. Now, what I did was I deconstructed, because I said, it doesn't make sense for me to try and outsmart the smartest people on the planet. That's dumb, right? And so I kind of re-engineered it, and I asked myself, why is it that super smart people are not guaranteed to succeed in this endeavor? And I'd love to hear your answer to that.
Yeah, I think a lot of it comes down to is you can't write the formula down for success, right? If there was the roadmap, it would have been discovered by now, right? We could by all these smart people, right? So if we had some roadmap that was guaranteed to success, then we would all be on it, and probably it wouldn't be as successful, right? You know, the return would go down, right? We'd all kind of arb it away. But I think that, you know, what you find too is that smart people also have trouble with your emotional intelligence, right? And some of this, you know, trading is an emotional game, right? And I think part of the behavioral aspects of it really doesn't always go with that super highly intellectual personality, right? That, you know, you struggle with the interpersonal skills, and that interpersonal skills can be interacting with the market, the traders, trying to figure out how to, you know, kind of seize on that opportunity. So I think some of it is just the personality types as well. But there's, you know, we're talking vol, right? At the end of the day, none of us know. You don't know what tomorrow brings. We don't know what tomorrow brings in the market. And so I think that some people struggle with that too, just that epsilon component, right? That there's this unexplained thing in the model. And I think sometimes that, you know, highly intelligent people struggle with that, right? They want it to be completely explained. And I think that's one of the challenges there.
No, is there an argument of ego that I wanted to say? Because, you know, you were talking about how, you know, sort of stuff repackaged or rebranded. And I always think, because I'm the outsider here, you know, I always think if someone's doing well, why don't you just copy what they're doing in some way? Because if it's working for them, it can work for you. But I wonder, is there always a sense of ego in your world where I don't want to do what someone else is doing because I want to do it my way, and I want to show everybody I can do it, instead of just actually maybe following someone else, making the money, and everything's good?
Yeah, I think it just depends on the entrepreneurial spirit too, right? Because the fake it till you make it, it works a lot of times, right? But it's where do you achieve success, or how do you define success? And so, you know, if you just want to do what someone else is doing, and you don't want to have your name, your brand, you don't want to leave your mark on something, then that's completely acceptable, right? But a lot of us don't want that, right? Or you want to make a name for yourself, or you want to have a hat with your name on it, or your name on other people's, wearing on other people's heads, right? And so I think at the end of the day, you know, when you talk about, you know, the ego, I think you have to have some in here, because you have to be confident enough to do the trades, right? To put the portfolio together. I mean, it takes a lot of courage to do that. But also you have to, I think it's also, there's a lot of humility, because you're going to be wrong. You're going to be absolutely wrong, and you're going to do it sometimes in size, right? And you have to learn from those experiences too. So that's what you have to have, some form of ego, but you have to balance it out and have that humility on the other side, because we all know the most dangerous thing outside of leverage is hubris, right? And that'll crush any manager out there, because you know, the system is much bigger than you. And I can just think about, look at some of the stories like the FTX thing that's happened, you know, in the last week. You know, that's a hubris again, right? And so I think there's a lot of these things that get repeated in the market, but I think, you know, really creative things are what people look for, and I think it's what keeps us all, you know, interested in the business.
But on the hubris, because I worked with quite an inspirational character 20 years ago, and he would take no ownership of errors. Someone else made errors. You know, there was a conceit, but he was fantastically successful, and I was kind of still, my brain neural pathway was still forming, and the dilemma for me was, did I have to be that conceited? You know, and I took it to the level of the men's or the ladies' 100-meter sprint final at the Olympics. You know, to be in that final, to be in that selection, you cannot literally chemically distinguish between the athleticism unless you're a generational person. And yet one person wins, and they win by these preposterously small margins. And is it because they channel all of that ego and conceit, and they say, I'm the best? And I just thought, I couldn't get there, because to your point, conceit, I couldn't see how conceit could give me tenure. Each year I wanted to do it again and again and again. And I couldn't solve for that. I don't know, again, if you've had that consideration.
Well, I think too, another way, it's all about approach too. And so, how does one become the best? And, there's all the studies out there that say, the best fund or the best manager one year tends to be, on the other side in the next couple of years or something like that. There's not a lot of pattern of consistency of that. And so if you think about it and you want to have a long career, one way that it was taught to me, and this was from Mr. Gunlock, was that you don't have to be the best every day. You don't have to be the best every month. You don't have to be the best every year. You've got to be good enough. And if you're good enough and you string a bunch of good enoughs together, you look back 10 years later and you were great, right? Because people don't have that consistency as well. But that's a different approach, right? A lot of people that get in this business want to be the number one performer, the best, the master of the universe every single period. And, it's very difficult to do it in any one period, let alone consistently. So I think it's also about that approach. And that's one thing that I've learned, is that if you can find things that, you can be good enough, you can just, beat the benchmark, year in, year out, all of a sudden you look back and it's like, wow, you were a top decile or top percentile type of performer. And so it's a different approach, right?
But, I think, actually, thank you. I think you've brought clarity to that dilemma which has haunted me for 20 years, that actually the answer is you just want to compete 4 years later in the final, and 4 years later again, and say, consistency, I was there. And as we're seeing with the FTX, that kid, he won 4 years ago. But
that's right. Yeah.
He's gone.
And like, you're talking about $1 billion, poor guy, he's only worth $1 billion now. I mean, who knows what it looks like, if there's any liquidity there or not. But you won, and when you win, you should be thankful for it, be happy for it too. And most people don't, they're not Elon, right? They don't have a PayPal, they don't turn it into a Tesla, they don't turn it into SpaceX. They don't have, multiple huge successes. And so sometimes when you have that success, you gotta take a step back and, chill out in St. Bart's for a little bit and enjoy it.
But can I say something? Because we're talking about tenure, and I know Hugh's going to come back, but just if I can just quickly think some of my mind, that I always think, obviously I know Hugh a lot better than I know you, Jeffrey. And, Hugh's a great guy, but he's got a ruthless side to him that, that I think Hugh would admit when he's got to say something, he's got to do something, you say it. And there's been a few episodes podcast where he's went through people, and I can imagine when he was working, he was even more, ruthless. I mean, how ruthless have you got to be? How ruthless do you think people have got to be success? Because we're talking about, being, having an ego and, hubris and being, interpersonal. But there's got to be a point where surely you've got to be quite a ruthless person and sort of,
you
put
do.
your foot down.
And I think if you surveyed my team, some people would provide those comments as well on that side too, and say that. But I just don't like to settle for mediocrity. Right. It's that, people, we expect the best out of them. We pay them commensurate with that. And, you want good ideas. You want good product back out. Like if you're putting together like a PowerPoint, I don't want to see typos in it. Right. I mean, those things drive me mad. Right. And so it's that caring enough to, bring their best every single day to the office. And so, I'm not really a screamer. I'm more of I'm very disappointed in you kind of guy. You'll know it. You know where you stand with me on the desk.
So if I show up with a PowerPoint with this typo, what do you do?
You're gone. We're not listening. We're not doing the meeting. Everything's wrong. I learned that early on, that if there's one mistake, it's all wrong. And so you don't just go fix the mistake. You got to start over. So if it's wrong, it's wrong. I mean, look, we're talking about credibility. I think what Hugh said was perfect. We're all competing in this 100-meter dash. And the difference between it is it's so infinitesimally small, right? And so when someone comes in and gives you a proposal like that, they didn't care enough. If you don't care enough, why should I care to take this meeting? Why should I listen to you? And, that's always just kind of been something that was ingrained in me, just, having that attention to detail. And so I think part of that, it's maddening at times, right? And you're just like, well, do you even care? Right. And if you don't care, then why are you here? So, every once in a while you got to have those conversations. And, again, but you also have to put in the same effort. You can't, Hugh's experience, he's talking about the guy wouldn't ever admit a mistake, right? You have to own up too. You have to do it. I mean, we're not perfect, right? But we have you to make us look perfect, right? You make us look good, right? You put us the data, you get it together. And so, there is a ruthless side a little bit. And I think a lot of it is just, again, not selling for mediocrity.
Yeah, I find that the other side of that is it makes you a very bad poker player, because when mediocrity walks into the room, I don't have to, my face tells the other person that they should leave.
So that's why you have that look every time I see you, Hugh. Now I was wondering what that look was.
Yeah, no, and I think there is something about it too, that you have a high expectation. As we said, these are highly functioning, very, very high IQ people that are around us all, and so act like it, and we're not in the world of academia. And so I have an analyst who came from academia, and he was a physicist, and I remember some of the first projects he was working on with me. He was just saying, well, it's close to right. Yeah, I got the gist of it. I'm like, yeah, but it's sloppy. Like, yeah, but I got the, so that took a lot of, breaking the horse in. It's just kind of riding someone too, to say, are you ever going to break through the ceiling part, right? You've got the skills. And I'd like to say he's been with us 10 years now. He's done a great job. He's moved on, and he now teaches other people how to do this. And so I think it's this cycle of really just trying to pull the best out of everyone. And I probably was more of a ranter earlier in my career, and at this stage now, I try to step back a little bit and say, okay, is it really worth it? All our blood pressure goes up. We have fewer days on this earth just because of this. Is it really even worth it? And so I think it's just having people that care. I think it's important, and that's what we try to instill in everyone, is that be proud of the product. This isn't my product. It's not it's our product. Right. It's our collective success. It's our collective failures. But when they're failures, we own them. Right. We don't expect the junior analyst to own them. It's my name on there. It's my fault. Right. You have to own it. As someone told me once, who runs the strategy? It's the one that goes into the front of the client and tells them about it in a very horrible market. That's who's running the strategy. Right. The one that everybody has this success when money's pouring in, and everybody contributed very well there. But the other way around, it's a lot harder. And guess what? 2022 is one of those years. It's a lot harder.
I was going to ask about that. So because there you are trying to, we're all like, some of us are trying to be Rolling Stones-esque, and like you say, but we have these parameters and control barriers which keep us steady, which allow people to congregate, put money in. But at the essence, you're trying to instill that kind of magic creativity to take on this preposterous assumption of seeing tomorrow. Okay. And that's wonderful. But then you get contextually really tough years where it's hard to be different. And like you say, this is a tough year. So how do you deal with, is this just kind of like you put your head down, we just got to get through it, and then we'll bounce back again? Or
yeah, I mean, that's been kind of, I feel like some weeks at our investor meetings, I'm more of a cheerleader than anything. I'm just trying to keep people fired up, right? Because you're getting negative returns, right? You're buying assets you think are good assets that are going down in price, right? You think that they are good for a long run investment. And by the way, because we have, daily liquidity vehicles, money walks out the door every day. Right. And so, and not every single day, but practically most days it feels like this year. And so what do you do there? You got to keep your value threshold high, right? That's one thing I say to the team many times, is like, make sure that you're re-underwriting for the new environment. Everything looks contextually cheap. If you screen things like in the fixed income marketplace, you're getting things that if you look in the last 15 years, they're probably in the cheapest 5 percentile, right? Does that mean that they can't go down? No, they can still mark the market down. So I think what's the frustrating thing in this type of environment is when people are also wanting to sell their assets, right? So they want to divest from the strategy, right? Because they're doing something else or they're just tired of losing. And when they come back, you've got to be good enough, right? And so this is coming back to that first part we talked about, being good enough. So you want to be able to say, like, look, we outperformed in this area. Does it suck to be down double digits? Absolutely. It doesn't make any of us feel good. But when money comes back, those screens are going to be important again. You got to look at the 3s, the 5s, the 7s, the 10s. That's just what people are going to look at. And so it's just making sure that people can stay focused, right? When you're in a down market and you have to sell assets into it, it's demoralizing, right? Because you're like, this has good value, but we have to manage the risk of the portfolio too. So it's juggling those things together. And like, when you're getting beaten up, I mean, you've looked at your funds before, and when they're you have these runs where you're down, you get down personally, right? Emotionally. And you have to get that reset button too. So it is difficult, but I think that's part of that long-term playing the game, is that you got to be good enough. And at some point, money will flow back in the asset classes, right? It just does, right? That's what's going to happen. And so as you said, it's preposterous to try to predict the future, and me trying to predict that moment that's going to change is preposterous as well.
Yeah, but like you say, the loneliness of risk taking. The danger is, like you see confirmation, mirror, mirror on the wall, which is your P&L, right? Mirror, mirror on the wall. Who's the prettiest of them all, right? And if this year, if you ask that question too many times, it says, you're an idiot, you're an idiot, you're an idiot, you're an idiot. You go, right. And you start to believe it. If you ask it one time, if your cadence is slowly set, it goes like say, hey, you got to the 100 meters final. You got to the 100 meters final. You're a genius. So again, it's control. But what I want to say, tell me this. So like a large element of your franchise would be the kind of the intellect, what you bring into fixed income markets. Yeah. And macro is having a pretty decent year out of fixed income. Is that not permitted for you owing to the guardrails in terms of, the obligation to have particular types of funds? Or do you have a fund where there are no guardrails and you're kind of macro-esque in your performance?
Yeah, so that would be more like our private placement, like a hedge fund type strategy. But most of our investments tend to be on the long only side. And so, you just have limits on what you can do there. On the macro side too, I mean, like what's won this year is just shorting rates, right? If you short rates, if you short credit spreads too, either of those trades have been just killer for this year, right? But I think the tide's turning on that. From my perspective, I think, look, it's calling the end of this inflation era is going to be tough. I think the market massively overreacted last week by a whopping 20 basis point downside in CPI. It's like, we're all clear. The Fed's done. I mean, they took like a hike and a half out of the market on one trading day. I think just everybody was short going in because it's just been so bad. It smelled like a short covering rally on everything. But when you start to look at the environment now, just how much tightening's been in the system, the quantitative tightening that's going on, that no one talks about, right? The Fed no one even asks the questions at the Fed press conferences anymore about it. So that truly is an automatic pilot. But if you think about this rate hike regime, it will be, if they deliver the 50, which is widely expected next month, I think they'll do 50. It's going to be the highest, that the Fed's ever hiked in a calendar year. Now it's by 25 basis points. Who really cares? It's not a big, it's not like we're in a late 70s environment where they're hiking 900 basis points over 2 years. But I think that the tide is turning on this because we've slowed things down. You see it across the board. The refis and stuff inside of the corporate market, they're going to get costly. It's just going to take a little more time to work through the system. And so my fear about all of this is that, the Fed is looking at all this lag data. Again, corporate spreads, they're a lot wider, or yields are a lot higher, but there's not a lot of activity going on there. So the interest coverage is low. So maybe it takes a little bit longer in this hiking cycle to feel that pain into corporate America. right? Because they did such a good job refinancing a few years back. So as you start to look at these things, I think that, the macro side is extremely important. But I do think we're getting very close to that inflection point. And as you said, as a risk taker, it's very lonely when you're trying to identify the inflections. It's easy to ride the trends, right? The inflection points are pivotal in one, risk management. Secondly, trying to seize on an opportunity. And so I feel like we're just getting to this point where now with yields where they do offer good protection against risk taking. And what I mean by that is you can just buy some long treasuries, whether they're 10s, 30s, something back into the curve, and it can allow you to sit in these other positions and feel comfortable, right? And so to me, it's that composition's changing, and that's what's happening in the macro landscape. Do I think we go back to zero? Probably not. But if we're going to have some form of recession, long bond can rally 30, 40 points, right? So it can offset some of that credit you have in your portfolio. So that's what we're really looking at in that we haven't really done that, getting long duration trade in the macro fund yet. We're eyeing it. We want to get that one almost right, where the other ones you want to leg into. But the other curious thing that I noticed is, we've been talking about it for a few years, is that we noticed that in the rates market, it seems that the end of the year tends to be kind of an inflection point to the high end rates or the low end rates for the year. And so it just kind of feels like coming into 2023, I think you want to reverse the trades you've been doing this year. And I do think that you're going to want to own kind of that back end of the curve type of duration to allow you to really take risk in other parts of the portfolio.
But can you really, I admire what's necessary, like you're beginning to see the honey. I love this Buddhist expression, licking the honey from the razor's edge, right? You can see the honey and you're thinking, you're a bee, you're buzzing, you're thinking, I want to lick the honey. And I really want a lot of honey, like there are points, like you say, this is such a big macro event. And it's, but again, is that the mistake? Like you have to temper that. I guess what I want to say is, do you think you no longer can make reputational bets?
No, you can't, and you have to. You have to be able to do this, and so it's one of those things where they're called futures. Just put the trade on, and you just have to live with it. Now we all know, Hugh, that the other side of that is that your clients will also call you an idiot, right? And so they're going to say that, like, I bought this fund for you to do whatever you want, but don't do that. Right? Don't do that. Why would you do that?
The infamous story of Michael Steinhardt. He was loading up with 10-year in 1982, and he had an amazing, as always, he had an amazing performance. But went a little bit early, as is that's what we do. And he had clients suing him for style drift. He was not allowed, what are you doing in fixed income? He's like, well, they yield 16% and inflation is collapsing. I'm buying them. No, you can't do that.
Right. And so, I mean, that's where the parameters come into things too. And so, for kind of the core kind of fixed income positions, we've been adding duration for the last couple of months, just stepping into that. But for this type of product, this is something that, we'd slap another 4 to 5 years of duration on, overnight, when we're ready for that. So that's something, it's a different vehicle, right? So I think at the end of the day, right now, you're starting to see that. But as you said, you want to lick the honey, but then what happens when the client takes the honey away, right? So you get your positioning, you want to do it, and then all of a sudden, no one wants you to invest for them, right? So it's a delicate balance, right? And that's part of it. And I don't call it marketing or gamesmanship, but you still have to do it in the right proportions to the vehicle, right? And so, to me, I think credit looks very interesting still. Yeah, I think we can have a recession, but guess what? Maybe spreads aren't as wide as they are typically in a recession. But as you said, you got to get in early. You can't go lift credit, right? You have to build credit positions. It takes time, right? We buy cash securities. You don't just whip it around. And so I think it is one of those markets too, where, there's going to be winners and losers in this whatever this kind of recession looks like next year. And is it mild? I'm going to call the soft landing the mild case. And it stays kind of concentrated in a couple industries and doesn't have knock-on effects. If it's deeper, then spreads should be meaningfully wider. But also, I think that's a combination of rates rallying too. So, spreads can widen just by rates coming down, right? People forget that as well, especially if you are in kind of a deflationary bust. So I don't know if we're there yet, but you're starting to see signs of it. And I mean, if you can put together a credit portfolio that, again, it's going to be below investment grade, right? I mean, if you want to take risk, you can put stuff together that could easily yield 12 to 13% today. Okay. You can put that together. It's calculated.
Yeah.
Okay. And then you can slap a rates trade on it. Right. So guess what? You have a kind of a barbell type of position that could work out there. And so look,
do you need some convexity on the other side to guard against the credit?
So you have the credit convexity because those things aren't being, those loans aren't being made at par, right? These are things that trade at
the convexity. Yeah. I'm saying the convexity is on the credit side, and it can be up your ass. You're barbelling. Right. You kind of need a hey, what if the Fed's going back to zero kind of thing as a protection? No.
And that's why you put the rates trade on the other side, right? And it's getting to that point where it does look very interesting that you can balance these things out. And that's something we haven't seen since really 2011, right? Where you could actually go out and do these type of positioning. And so, people got lulled into the low rate environment that we're going to be low forever. That's in the rearview mirror. Yes, if we have another recession, the Fed will cut rates. They're telling you they're only going to go to neutral, only going to go to 2.5, but 2.5 is a long way from the 5 they're going to, right? So there is the ability to do that, and you're absolutely right. You need that positive convexity if you get to this kind of bad event. But if these assets are trading like 60 cents on the dollar and they're not distressed, right? Remember, the interest coverage is what they're paying, right? They're not paying the yield that we're obtaining, right? Because they've already financed out there. So that's why I say I think you have positive credit convexity. Even with a recession, the average dollar price that stuff probably is at least 90, right? So you think about that. There's 20 points sitting on the table there. It's just how are you going to get it, Hugh? Are you going to get it in 12 months? Or are you going to get it in 36 months? What's it going to look like? And also how do you weather that storm? And I do think that it is the time to really be circling the wagons and looking for this kind of deflationary bust scenario as I won't call it a tail risk, but I'm going to call it a component of the portfolio today.
I'm glad you made reference to 2011 because I was going to ask you, there's this intangible thing, this experience, just having, again, had the tenure, having participated in all those final races. I mean, here I am in St. Bart's. I look at charts, they're on free websites, I have no Bloomberg by choice. Some people think I had money in, God forbid, FTX. And yet it comes to me. I don't know if it's clarity, but I hear voices, I'm disseminating, I'm having that macro dial. I can't switch it off. I go surfing, I do yoga, I play paddle, boom, I'm still thinking about it. And so you're doing the same, and your deliberation is 2011. And for the folks watching, 2011, the Fed went QE. Everyone rushed into commodities. Commodities had a huge price, and at the same time, China was just laying down concrete and building these properties and consuming. But people came in to protect their wealth against hyperinflation. The commodity miners put in a ton of capacity. Just power went to 30 or something, and they all got wiped out. And like you say, by 2011, people had to go, it's the wrong trade, and all got, and we had COVID, and everyone again kind of went back into property. They went into Bitcoin. I've got to protect myself.
That's right.
And then and you can see it all being unwound, and the last thing is always the Fed to get it. It's the guy at the end of the you can't wait for the Fed. It's like waiting.
Yeah, well, I mean, that's a perverse thing about them being data dependent, right? Because the data they're looking at is backward looking. So by the time they get it, it's a confirmation bias that it's too far ahead. They're too far gone into it. And so I think you're absolutely right there. And look, the QE playbook will be open again when they need it. And I get the question a lot recently from clients saying, well, now with yields where they are, what about the deficit now? That's starting to come to a lot of conversations. And I'm like, Don't worry about it. You know why don't worry about it? Because guess what? They already have $4 trillion in treasuries on the balance sheet, financed at zero. Guess what? They can go buy the high coupon ones next time, right? When they want to do it. And so, you're starting to hear those same similarities. I like that you brought that up about 2011, but I do see that a lot of those thematic ideas that are back in vogue again. And, it's the antithesis of QE. It's, we were foolish to think that, everything's going to be tech all the time. And it's just these very similar themes that we've seen before. And so I think that as you look at this environment, there is a lot of similarity there, but also there's just still this risk of inflation that we haven't seen really in a few decades. And I think that's still the overhang on the market, and it's going to be. And look, if somehow we can engineer this glide path to whatever, I love the economist forecast. No matter where inflation is in the next 12 to 18 months, it goes to 2, right? I mean, even if it was 8.5, it's going to 2. And it's like, I don't know. I don't buy it that we're going to that level. And I think that, we've put a lot of juice in the system. We've done, a lot of, wage shifting as well. Prices were extreme, every single, S&P 500 company, when you look at profit margins from June of this year, it was a 40-year high. How can that be, Hugh? How can it be a 40-year high when we're all dealing with inflation on this? It's because they passed it through thinking it's coming, right? So you have this kind of self-fulfilling side. And so I'm just concerned that, when we get back on the glide path, it's not 2 anymore. Maybe it's 3, maybe it's 4. That's the new level. And if that's the case, we still have some more resets to do, but it's getting closer. It's getting closer. And then, look, if they get magically to 2 and they don't overshoot it, kudos to them. But I just don't see it. Right. When you overshoot one way, you overshoot the other. Right.
Indeed. And they're looking at corporate. I mean, corporates are monkey brain. I mean, and I say that I have a monkey brain. So yeah, I'm not throwing bricks or whatever. But, corporates sat there going, 2 years ago, going, shit, we don't, like, people want to buy stuff and our shelves are empty. Like, order. Yeah. And it's like, there's a delay. And they're like, what do you mean there's a delay? Order more. Right. And it's an avalanche. I mean, I look at so they produce 2.3 GDP growth third quarter, thereabouts, yeah?
Yep.
What happened? Like, corporates stopped ordering because monkey brain went, hey, stop. We now can't sell this stuff. Stop, right? And so you take the negative drag of like less imports, your GDP is strong. Is that a good strong? No, it's not. It's actually, it's all unwinding, but... Yeah,
I thought that at the beginning of the year when I was looking at the GDP releases too. I'm like, well, look, you still have consumption, right? So the consumer's there. You had private fixed investment in the first quarter, but as you said, it was the deficit. It was the trade deficit and government spending. I'm like, kudos to that, right? Then we got that again, and so now you're starting to see again some of the government spending coming back into there a little bit. But look, the consumer somehow this year has stayed strong. Right now, are they using credit card? Who knows what it looks like? But also, I think some of it has been, the lifestyle. I think people sold assets. As you said, people went to real, tangible things. We were talking about this before we launched the podcast, right? Buying property, doing real things with money, monetizing that. And I think they also did it with experiences this year, right? So you saw this with the service side of the equation, even stripping out shelter. Services remain strong. And I think some of that, again, it's a hypothesis I've batted around for a little bit and, can't prove it. But I feel like if you look at money flow, if it leaving the asset management space, I think it went to experiences as well. Right. And so I think that's part of that consumption pattern. Now, that's not tenable for the long run, but, none of these policies are. So I just think that you got to watch that side of the equation. Obviously, housing's a problem in this country. Prices, the affordability. I love hearing the stories about, well, when I first got my mortgage, it was 17, it was 7%, 9%. There's no big deal. And I'm like, yeah, but the house was 1/8 of the price that it is today. Right. And so it's all about that payment. And so there's going to be some slowdown undeniably. But that's the definition of what a tightening cycle is. So what I'd like to see, you talk about the monkey brains. I'd like to see, things get flushed out. I'd love to see the zombie companies, again, I'm not rooting for anyone's demise, but let's go through a typical, deleveraging cycle and let's flush out the bad actors, right? And I think that's what you're seeing now, that any business model is predicated on low interest rates forever is challenged, right? And I think you're going to see some of that in 2023 start to see some cracks.
I cited, the Buddhism of, the honey and the razor's edge. And in a big thing which I've taken on this year is, the impermanence of life. I think that Steve Jobs' famous speech to the university kids was, when you're calibrating downside, you've got to remember that you're going to die. You're every day you're dying, right? So once you understand how kind of ultimately shit things are, just deal with the other stuff. Okay. So, and again, back to your involvement in the universe of fixed income. It has been a profound and very long bull market. Now, I say profound because it's a bull market, if you will, in the risk-free rate. And up until very recently, that came with a very low volatility relative to other asset classes. And therefore, it allowed you to leverage, and it never let you down. And indeed, what's he called? The hedge fund that does the vol adjustment through the permanent portfolio kind of idea. Those guys made the biggest return to investors in history, because they began in 1980. Who am I thinking about? What's the biggest hedge fund? Ray Dalio. What's his thing called? Bridgewater.
Bridgewater.
Yeah, so Bridgewater's.
Yeah, I mean, if you think about the all-weather, or go ahead.
Yeah, effectively, you ran a vol model that said buy more bonds, and you started that 40 years ago. I'm not putting it down, but context is a wonderful thing. But what I have a flight of fancy of a theory that I'd like to, and it's a preposterous theory, so obviously it's an asset capitalist theory. So impermanence, we have something which has lasted. It feels like a lifetime. It isn't an adult lifetime, okay? But we know that everything comes to an end, okay? And I'm trying to kind of I'm trying to role play the end of the treasury bull market. And to role play the end, I'm going back to the beginning. And I'm saying the beginning was marked with absurdity, in that, the Fed had a very aggressive rate hiking in a very like a real-time severe recession. Okay. We weren't considering how bad the economy was going to be. It was bad, and they were hiking. And that went on for at least 2 years. And if you had a pulse, you could determine that inflation was in abeyance and collapsing. And the absurdity was, despite that, you ended up at 20% Fed and 16%, 10-year rates. That kind of, like, we talked about Michael Steinhardt being sued. An alien coming and looking at our world would say, that's kind of weird. Like, human beings are it's absurd, right? You're doing too much French philosophy. Okay?
Well, I think we tend to be too much of what I'll call the naive extrapolators, right? We take recent history and we extrapolate it out indefinitely, right? And so I think some of that is that, when you saw rates like that, it's like, well, they have to be that because they've been there. And there's a lot of anchoring that goes on in interest rates. I think that, at some point you're like, well, we can't stomach a 2% 10-year. I mean, how many times did you hear that in the last couple of years? Like, it'll destroy the economy. And what happens is that you just get the psychological barrier. You hit levels, and I equate this to people who go house shopping, right? The mortgage rate's 3%, or it was a couple of years ago, it was 3%. Like, oh, I can afford this. Oh, wait, it went to 4%. I'm not buying anything. Then 3 months later, you're like, well, 4.5%. Who cares? I'm just going to buy it. And so there's just something where there's this human nature that we tend to anchor on specific numbers, and then we extrapolate, right? And that's what a lot of forecasting is just naive extrapolation.
Yeah, but let's talk about less naive extrapolation.
But also,
sorry,
go ahead.
I'm curious. With regard in the inner sanctum of your franchise, someone has to be role playing and asking the question, what does the end of the treasury bull market look like? And will we be able to see it
Yeah, I mean that's our $100 billion question, right? When you think about it, and we've always been able to finance these things, and people come back to look at debt to GDP ratios, and we're essentially at the point of no return, right? But I think one thing that we should be thankful for in this inflationary environment we've experienced is that we've grown at nominal rates, right? That helps erode, it erodes purchasing power. So I take that as one of the side effects of it, but that's part of the whole financing scheme, right? So to have some level of inflation to kind of dilute the purchasing power of the Treasury is exactly what they want to do. And so it's one of those things where we've always relied on some form of external financing, right? It's always been Japan has been one of the number one buyers. China was there for a bit. Maybe that gets a little rockier going forward, but we now know who the buyer of last resort is. We know it. It's called the Fed, right? Yeah. And they're just going to sock it onto their balance sheet, and they're going to continue to do it. So what does the end look like? I don't know. I mean, maybe those hyperinflationists were right in 2009 and 10 and saying all this QE is going to lead to inflation. Maybe it got pent up in the system for so long. That's not a very popular opinion, right? But ultimately, where it ends up, it's hard to see because we don't hold our elected officials accountable, right? They just spend on personalized packages that help their constituents only, and it's a very challenging world like that, right? That there's just no responsibility, and so the fiscal restraint went out decades ago, right?
Yeah, but then it's too easy. I mean, it's legitimate to have a go at the public, leadership, but there's a profound deficit, I think, in the kind of the intellectual pool of advisory and an understanding. You said you are, of course, very well read. I would put it to you that the orthodoxy that you came to understand has not been relevant for the last 20 years, at least.
The orthodoxy there, it's always in question. And so I think, if you take someone who's been in this business in the last, let's just say only the last 10 years, they think the orthodoxy is QE, right? There's no such thing as a temporary program when it comes to intervention, right? QE was supposed to be very temporary, right? They were only going to do it for a few months and it was over, right? But that has become the orthodoxy. And then just look at what happened in the UK last month, right? They in the middle of fighting inflation, they said, no, we're going to cut taxes. We're going to do QE again. And the market revolted, right? And so I think what is the orthodoxy? It changes because that's something that worked in a very low inflation environment. And, we haven't seen these levels of inflation. I think that is really what's changed, is that people are now saying that, wait, maybe these programs, maybe the magic money tree or MMT, as people called it, just doesn't work, right? You're going to get to the point of having some form of inflation. And, maybe we'll look back and say in 2020 and 2021, we shouldn't have given as much money out. We gave handouts to everybody, right? We get PPE loans, senators got them. Corporate America got a lot of it. There was just a lot of money being sprayed around. And so I think that should probably, kind of nail that, put the nail in the coffin on that theory at this point in time. And, people just don't like inflation, and that's a completely different regime. And so when you talk about the orthodoxy, I think it's all about reference point too. And there's a lot of it where people start their careers or what they've experienced, right? We're all a function of our own experiences. And so if we have that experience, it's all we know, right? And that's where I think, as you say, you need to learn about other environments. You need to learn about different regimes. You need to travel. You need to see things. You got to open that mind to be able to think things that challenge the orthodoxy.
So my take on absurdity for the end of the Treasury bull market, because people think we're at the end now. Like, inflation has emerged for all of the phantoms, if you will, that you've mentioned, from QE to MMT, and very hard to put it back in the bottle. And of course, like you said, consumption has remained durable. It's withstood the nominal shock. My feeling is that this could be the end. Bull markets end with the kind of the adult life expectation, like where you procure your wealth for the latter stage. So you've kind of like got 35, 40 years, and you find bull markets kind of something, who knows, kind of cooking. I can't see how the greatest bull market in the history of financial markets ends with everyone being right. Yeah, we've got inflation, yields go off. So for me, I bring back absurdity and I say, I actually think that the Fed, because its purview of money is so narrow, and like the monetary inflation was out here, it was non-sovereign money via the euro-dollar system, that inflation is a monetary phenomenon, and the only inflation we got was in asset prices from like dollars created offshore seeking to replicate themselves in an asset bubble. And as that unwinds, and it is dramatically unwinding, you're actually seeing the destruction of money, or the destruction of the rejection of collateral, and therefore the definition of high-powered money is shrinking back to US Treasury bills and is profoundly deflationary. So when I look at it, I actually think it wouldn't, of course, it would be absurd if the Fed had to go back to zero. If we went back to 50 basis points on the 10-year, and that would be the Fed at 20% in 1982. And then everyone would be, oh my God, we've got to buy treasuries again. And at that point, I think, that's the end of the bull market. You see, you've kind of got to think.
Yeah, and I feel like, if you look at the charts, we did break out of all the channels, right? Those downward channels that were set since 82. And so, is it a head fake and we're going to retest or not? I'm not convinced, because I just think that it comes back down to the inflation genie, as you said. It's out, right? I think the Fed would take a victory lap to get a 3.5% inflation rate. If it was there for a while, I think they'd be stoked with that. Well, if you have a 3.5% inflation rate, how the hell do we get to a 50 basis point 10-year? Right? Like that's the thing. And so I agree with you in the capacity that, it is going to be a challenge once we get to this. But look at money supply, right? M2 growth is going negative, right? That is a deflationary shock usually. So that's kind of why I'm also saying I like this deflationary component for my portfolio, right? And so I do think that, there is a piece there, but it's also, there's a lot of risk to this too, right? That's why the trade's not on yet, right? What if we get a sneaky inflation report next month, right? And then all of a sudden, right? Yeah, I mean, what if you get it? It's noise.
But it makes the path very unpleasant, and I guess
it's unpleasant. Yeah, but I think, look, the market's got it priced. We came off of the hikes a little bit. Euro dollar curve says, we probably get to close to 5 in Fed funds. It seems right, with the path they're telling us. And they just got to stop at some point. That's the risk, I think, to all this. If the Fed doesn't stop, because they need it to lead, they need to just wait for these long and variable lags. And I'm afraid that potentially in this environment, that maybe the lag is a little bit longer because of the lack of financing needs, right? Because corporate America did so much in 2021 and extended maturities out. There's no high yield maturity walls. These are usually the signs of things that cause stresses in credit markets. And so I'm wondering, because of the path has been so fast, it hasn't really went into the system, right? Because there's not all this borrowing that gets done at these rates. They're done at, the previous interest rate level, just yields are higher. So maybe that's a different lag in the system this time, which then emboldens the Fed to go too far, right? But I think the reason we're talking about this, in the Fed is because that is the number one centerpiece on how you're going to make money going forward. You've got to get this trade right on the Fed, right? They've got to get to some point where they've got to stop, and then we got to see what happens in the system. And, I just don't think it's there yet. And,
the Fed will stop when the damage of its policy becomes shockingly apparent. I can't think of another time when the Fed didn't stop because it had to, because circumstances demanded it.
Right. And I think what you're seeing in the markets too is that they're getting to the point where they're pricing now the rollover in the Fed, or what they call the Fed pivot at this point in time, that they're going to cut rates. But to me, that's just extrapolating the last experience, right? The last hiking regime ended in December of 18. They stopped hiking. They cut rates in March of 19, right? So all of a sudden it's like, 3 months. Well, that's monkey brain again says, That's what just happened last time. That's what they're going to do this time. And you kind of see that a little bit in the curve. But normally they have to stick at these levels for a period of time. And so I don't want to bet on the Fed rollover effects. But guess what? While we're waiting, if I buy a 30-year treasury and it yields 4, at least I carry while I wait. It's not going to get you rich, right? But it's not yielding 100 basis points like it was 2 years ago, right?
I think the 4% treasury is kind of close. I think the 4% treasury and the Fed terminal rate at 5.
Yeah.
You consider the 70s, and let's approximate, right? Debt to GDP, 70s was the end of a 40-year deleveraging cycle. It was 1x, a little bit more, but call it 1x, right? Today it's 4x. And so I want to say that 4% treasuries are the equivalent of 16% treasuries in June 82 and 20% Fed funds rate. You know,
makes sense. Yeah, I mean, the logic completely makes sense. And I think that it's right. The curve should be inverted. Because again, I don't think we're staying here for a long period of time, and it's going to be hard to drag that back into the curve up to 5%. I think, you'd have to see, in order to do that, I think you'd have to see inflation be more persistent, and we're continuing to grow and not have a deflationary scare, right? And I think that's the problem, is that when you look at the economic data, it's ripe for a deflationary scare. And I think that's what's kind of caused all this volatility in the rates market, is that you can see both sides playing out at this point. So I think there is a lot of equivalence to that kind of, late 70s, early 80s behavior.
To my mind, there's one thing to have a leveraged economy, and I get that. And people, they quote the debt to GDP without quoting the wealth to GDP, which supports it.
Yeah.
It's also very high. 2 stocks. But the golden macro rule is, don't mess with the carry. You can run elevated debt, but if you damn mess with the carry, you are going to bring chaos into the process. And I think we're very close. This is the dawn of chaos, if you will. Now, what I wanted to ask, I'm very conscious of your time, got to wind up. I wanted to ask, so I think the Fed is very guilty of being very inward looking and ignoring a lot of the exterior frontiers. And the revolution in 40 years in money creation, that there's way more dollars. Like, money has lost its sovereignty. The dollar has lost its sovereignty. The dollar is not the purview of local actions within the borders of America. It's actually being created in enormity elsewhere, right? And it's being created again by forms of non-dollar collateral, which are being unwound, and we see that in the dollar's rise. I just wanted, again, in your internal debates, what attention do you give to things like eurodollar, collateral, and also, because you said something which, forgive me, but it irked me, in that we were talking about external financing, Japan, and then it was China, how we were reliant. I think that's just, we were not now I'm American. I mean, I may as well be. America was not reliant. America was the only damn territory that was willing to accept a sovereign coming in with surplus savings and dumping it into your economy where it wasn't necessary. And China's, of course, just done that again. And China et al. Are responsible for cumulatively $9 trillion going into the US, right? Which would be incredible if we were the 19th century and you were building canals, multiple railroads, and you needed it. But when you don't need it, when you're the amazing thing about now is you can be a trade deficit nation, but your domestic investment needs are well covered by your domestic savings needs, right? And so the money that comes in effectively destroys the utility and the signaling of rates, of what real rates mean. And so you get misallocation, and you get bubbles. Bubbles are normative judgment. But my concern again, and the notion of where we might have to go really low, I think the last great deflation episode of this cycle is China. Is China, that 90 trillion high tech mark on their property, the slide.
Yeah, I mean, look, if you think about it too, I mean, it's undeniable that they're slowing now as well. You know, the zero COVID policy has been horrific for them as well. But if you look, they haven't really had the inflation because, as you said, they took it all and they kept it all domestically. And so as you look at kind of the next episode there, how do you even grow at, you know, what beyond what's in the developed world at this point? How do you grow beyond 2 or 3% real? And I think that's a big adjustment that we're all going to have to get used to there too. And, you know, I think, you know, just given what we've seen with the trade, with, you know, the trade policies and everything, I just think that China is not going to reinvest their treasuries. I don't think they're a seller, but I just don't think you can rely on them for that. And that's $1 trillion, right? That needs to come back in. Again, it probably goes out in like 5 or 6 years. So, you know, it is a problem because, as you said, you're so reliant.
It's kind of Say's law, like, oh, you're like, you know, supply finds its own, you know, its own supply. Like Italy always finances its budget deficit, you know, kind of thing.
Yeah,
and I think
they got a product. They've done great at marketing, man. We all love to go there. We love the food. You love the wine. I mean, it's fine. You know, they have something for you, right? And they got some old buildings.
Italy, not China. But you know, remember. So the environment where they would sell $1 trillion of treasuries, I think would be an environment where you and others would be desperately securing and wishing to buy those treasuries. They would only be buying those treasuries in a profound deflationary unwind of their economy.
Yeah.
Because
I think so. And that's something that's got to be on your radar at this point too. That they are struggling. They've blown their own bubbles, as you mentioned, with the property sector. It's in the tapes today on that, and people have been worried about that for a long time. And you know, there's a global housing problem too, right? Most countries, you know, you don't get a fixed rate mortgage like here in the U.S., and so they're highly sensitive to these interest rate environments. And so, you know, people just go back and think about putting cap rates on commercial real estate at like 3.5%. 2 years ago, and now bills yield 4.5%, right? So if you think about that, there has to be some unwind in that system too.
So it doesn't sound like, I mean, there will be within your, you know, when you're kind of having these challenging investment kind of, you know, forming narratives. It still sounds as if, and it's unjustifiable that you would be pretty much looking at the domestic pool and consumption and whatever. You wouldn't really be looking at these external factors.
No, not as much. And I mean, look, the right now the dollar is a great place to be, right? Forget the dollar itself. I'm just saying dollar denominated assets are what you want to own. They have high carry. You know, they're analyzable still. And at the end of the day, as much as it irks me to say this, we can print the money, right? We can finance it, right? We've got a mechanism to do so. So, you know, I just think that if you're a dollar-based investor right now, you're going to want to load the boat up on non-dollar assets, but I think it's just too early. I think it's too early at this point in the cycle. I think you need us to go into a recession. When the U.S. goes into a recession, I think that's when you want to reload on the other side. But I think until that point in time, I could easily see another blow off in the top in the dollar. Just if we have, you know, kind of that recession, the flight to quality brings money here and it gets repatriated back to the U.S. And so I just think it's early to load up on the non-dollar trade. But I think you want to be circling it. You want to be looking at it. And you got to pick your spot. But I think you're going to have to wait until, you know, we're kind of mired in that recession. And that's when you want to do that rotation.
The US is the lodestar. Inflation has to come off US first because it's being amplified by currency weakness.
Well, we did it the most. I mean, look, our M2 growth was like 25% back in early 2021, right? So we printed all kinds of money, right? It's got to work its way through the system. And I think that's what you're seeing. And some of that is through deleveraging too. That's going to be the erosion of that money. But that's exactly what's happened. But seeing M2 growth go negative for the last few months, that is very concerning. That's very concerning.
I refuse to talk about it, M2.
Okay, sorry. I don't want you to have a bad day, Hugh. I don't want you to have it. But hey, I've had a great time on this conversation. This has been great. I just love to talk to smart people, as you said, and just chatting with you. It's been a pleasure today.
Well, you've been very, very generous with your time. And
Jeffrey, before you go, I always get asked this on WhatsApp to ask people, what's a book out there for people who are into investing what book would you recommend they read? People that are, you know, maybe not complete rookies, but they're not professionals like you and Hugh, sorry. People are always asking, what do you recommend?
Yeah, my favorite book to recommend is called Against the Gods, and it was written by, I believe it's Bernstein, right? And it's talking about risk taking and how people, when they didn't understand it, the first thing they always blamed was their deities, right? The deities were the problem because they didn't understand something. So if you have a bad storm or something, it's the God's fault. And so I think anybody that wants to get into this business needs to understand the risk component of things. And I think he does an excellent job of laying that out. So it's called Against the Gods. I think the subtitle is like something about a tale about risk or something like that.
Yeah,
brilliant. All right, well, we'll get people on that then. We'll get Hugh. Have you read that?
Yep.
Okay, there we go. Take for Hugh.
Yeah,
take for
it's
Hugh.
A classic. Yeah,
take for Hugh. He's edging closer to getting a job offer at DoubleLine. He meets the requirements, and his PowerPoints are on point as well. There's no mistakes, no spelling mistakes.
Yeah. So thanks again, Chris. Hugh, it was a pleasure. Let's do it again sometime, and I look forward to the next discussion.
Jeffrey, keep licking the honey from the razor's edge.
And everyone else, listen to the Sherman Show with Jeffrey Sherman. You can find it online. Check him out, everybody. Thank you, Jeffrey.
All right. Thanks, everyone. Okay. Bye for now.